Good afternoon, everyone. Welcome to our webinar, Green Finance Beyond Transparency. My name is Sören Hilbrich. I'm a researcher at IDOS, the German Institute of Development Sustainability. I'm really glad to see some people in the room. We had more than 100 registrations. It's clear that not everyone turns up to these online events, but I think we have a good group here with diverse backgrounds, based in different countries, people from policy making, from development banking, from private financial market participants, also people from the academic community. So I'm very much looking forward to discuss this topic with all of you and with our two amazing speakers that I will introduce in a minute. Before we start, let me remind you that we record this webinar and we will publish the recording on the IDOS website after the event. Thus, if you don't want to be recorded, please keep your camera switched off. Before we go into today's topic, I would like to remind or to mention that this webinar is part of a new series that we set up at IDOS. We call the series Green Economy on Point. And the series will explore pressing sustainability transformation challenges and emerging opportunities with a focus on low and middle income countries. In the series, we at IDOS will always publish a policy brief and then have a webinar in which we discuss the topic with experts in the field. We have topics that focus rather on specific policy levers, as today. This could be financial regulation, carbon pricing, green standards. But we will also have webinars that rather cover specific sectors that we consider to be crucial for the transformation, like hydrogen, green steel, fertilizers, the food sector, or the construction sector. We have a few webinars coming up in autumn. The next will be in September on supermarkets as drivers, as potential drivers of the transformation. So stay tuned for announcements of the next webinars. So without further ado, let's get into our topic. I think the green finance or the sustainable finance agenda has been very prominent for quite a number of years by now. We've seen really a remarkable number of initiatives by private actors, of political processes, of new policy measures that were meant to better align the financial system with sustainability objectives. For instance, regulators have implemented new disclosure regulations. Standards for sustainable financial instruments have been developed. Many jurisdictions have established sustainable finance taxonomies, and so on. But now, from my perspective, we have arrived in a situation that I would describe as a situation of dual disappointment. First, beside all these efforts, we do not see the shifts in financial flows at the scale and the pace that would be necessary to achieve the climate goals, to protect biodiversity, and so on. Let me just name one number to illustrate this. According to the Banking on Climate Chaos report, it was published this month by several NGOs, the largest 65 banks globally committed in 2025 $508 billion to companies that actually expand fossil fuel developments. This number even increased by 27% compared to 2024. I mean, I don't want to deny that there has been progress as well. For instance, we all know that investments in renewable energy have also strongly increased, but that we still see investments in fossil fuel development at this scale, which comes with lock-in effects for decades, in my opinion, clearly shows that the financial system is still not aligned with the Paris Agreement. This is one disappointment. And the second one is that at least in some jurisdictions, we currently experiencing a backlash, even against those insufficient sustainable finance policies, initiatives that are in place today. And I think it's hot, at least for the US and the EU. where we see political pressure to cut back instead of raising the ambition of sustainable finance policies. So this unfavorable combination of existing policies not having the sufficient level of ambition and, on the other hand, increasing political resistance in some parts of the world against sustainable finance regulation. That's what we want to discuss today. The first part, we will focus on the political economy side, where do we stand in different parts of the world. And then in the second part, we will actually look on how the sustainable finance agenda could move forward. And from my perspective, moving forward entails moving beyond the focus on creating transparency to become more effective in actually shifting capital flows. But we will get to it later. We also have time for questions from the audience. You can already start posting questions in the chat. My colleague will collect them, and we will do our best in the end to address as many as possible of them. Yeah. So let me finally introduce our two speakers. We have really two persons here that are very well positioned to examine and illuminate the questions we would like to address in this webinar from a bit different perspectives. First, we have Shamila Subramani. Shamila is CEO of the National Business Initiative, a coalition of South African and multinational companies. She's also a member of the Presidential Climate Commission, which is really an important multi-stakeholder body in South Africa. And I think also previous work experience very relevant as Chief Sustainability Officer of the Johannesburg Stock Exchange. And she had also a role as UNDESA related to sustainable finance. So really, I guess, the ideal person to discuss these topics. Welcome, Shamila. Very keen to hear your thoughts on these issues.
Thank you, Søren. Good afternoon, everyone.
And our second speaker is Simon Diekau. Simon Diekau is founder and global director of the LSE Center for Economic Transition Expertise. He's also a distinguished fellow at the Grantham Research Institute on Climate Change and Environment. And his research focuses on central banking, monetary economics, financial regulation, climate-related risk. So he has really provided important research contributions to many of the topics we would like to focus on, and is also very active with respect to policy advice. Welcome, Simon.
Thank you so much. Wonderful to be here.
Great. So as I said, I would like to start with the current state of the sustainable finance agenda from a political economy perspective. I've said in the introduction, I've talked about this backlash in the US and the EU. I think it's pretty clear that we see something like that. There were these anti-ESG laws in the US. We have seen the withdrawal of many private actors from the net zero alliances, capital outflows from funds that are labeled as sustainable. At least some part of the EU omnibus packages, I would say, are also cutting back on sustainable finance regulations. But the US and the EU, I mean, that's not the world. Let's also look a bit on the situation in other regions. And I would like to turn to you, Shamila, first. You are very close to the private sector as you lead an association of private companies. But I think you also engaged a lot with South African policymakers. So how would you describe the current attitude towards green finance policies in these two spheres, no? In the private sector and in policymaking in South Africa, but maybe also beyond?
Mm-hmm. Thank you very much, Søren. And I think greetings again to everybody. It's a gloomy afternoon in Joburg, so I don't know wherever you are based in the world. I hope it's not as gloomy as the sustainable finance agenda. But it's great to be here. So, Søren, you've painted a little bit of a bleak picture, so it's a bit difficult not to feel gloomy after your opening comments. But I think that we need to also look at that, and absolutely we need to consider the context. There is no doubt that we're seeing the backlash. The backlash is coming from a number of different jurisdictions. I think we spoke already about some of Europe, we know part of the United States, and we've seen that pullback. In some fronts, we're seeing it in South Africa as well. And then we're also seeing it in some of the other developing markets. Recently, I noted that Brazil, for example, had removed their mandatory sustainability disclosure requirements and put it back to voluntary. So, it's signals like that that tell you that there's a shift happening in different parts of the globe. When we look at the sort of requirements for disclosure as the data point that gives us some sense of where this is going. And so the ESG backlash has been happening for a fair amount of time now, at least the last 2 years, more significantly than prior to that. And so in that context, I think, your own report, the IDOS report, correctly pointed out that sustainable finance policies themselves have become subject to political contestation in some of the major economies. When I look then at the data points, some of the other data points, so you've sketched out about the unfortunate increase in investment in fossil fuels that we've seen. But on the counter to that, we also see that the International Energy Agency's 2026 report said that global clean energy investments have already exceeded fossil fuels. So I think looking at some of those signals and the positive data points is what we also need to fixate on. And the question we need to occupy ourselves is how do we get more of that? Your framing of the problem and that it's what we have invested and where the money is moved to is nowhere near the scale that is required to fulfill the Paris Agreement is absolutely correct, of course. But I think if we get stuck in saying it's not enough and therefore we're not going, it's not working, we're not going to be able to make the effort on really pushing forward the progress that we have seen. And so if I look at that and, look at electrification through renewable energy, grids, battery storage, electric vehicles, industrial decarbonization, all those are still continuing to attract a significant amount of capital. And those are all positives for the climate agenda. And I think those are things that we need to point to and look at how to scale that. And that is where, if we put in that same effort, I think we could see bigger gains. Because in many instances, the economics of those investments are actually where the answer lies. And people are not just doing that because of some moral obligation or a commitment to climate. It's usually because the economics are actually making sense in those regards. And so those are the positive momentums that are actually the easier ones to pick up. So in South Africa, despite the geopolitical uncertainty and the reductions in development assistance that we've seen, some of the strong progress indicators that I can point to are looking, for example, at the climate finance goals. Those have increased, in fact. The latest climate finance landscape report, which is produced by the Presidential Climate Commission, says that we've mobilized about 188 billion rand annually in climate finance between 2022 and 2023, and the latest data is being collected for the reports. Predominantly, though, I think interestingly, a lot of that has come from the private sector. So we're talking about commercial banks and domestic investors playing a significant role. Just recently, earlier on this month, South Africa's National Treasury unveiled a new national sustainable finance framework for sovereign issuances to mobilize around $228 billion for climate goals in the country. And so, despite these challenges, we're seeing a sovereign in this case actually saying, we want to have a framework for doing that. We want to do that. And then, the question is going to be, okay, is a framework really going to help? I want to bring another data point there. We've also seen in the last few weeks that in South Africa, the Department of Trade and Industry issued the industrial development strategy for the country. And that industrial development strategy is very closely linked to the aims of decarbonization and has specifically linked priority sectors to that. So once we see an industrial development strategy, which really is part of the economic blueprint for the country, alongside a sustainable finance framework, those are very positive indications. So I did a very quick mapping to look at what the industrial development strategy is looking at and those priority areas, and then comparing to the sustainable finance framework in the country from a sovereign perspective, and there's a massive overlap. So ostensibly, you have a strategy that is going to hopefully drive industrial development in the country, and then a sustainable finance framework that has this very close mapping to the areas that have been prioritized. And that's the point, is that coordination, to answer the point, is maybe those areas that we need to look more tightly to be able to push forward the agenda. Because when it's rooted in reality, when you're saying, okay, this is what we can do from an industrial growth perspective, and actually the climate and sustainable finance agenda is aligned to that, and we have key points where those converge, that I think is very good for positive momentum. And then just lastly to add, the Just Energy Transition Partnership, so South Africa, as you know, landed the first JETP in the world, remains active despite the withdrawal of some of the international partners. And in fact, some of the existing partners that have stayed in the partnership have actually committed more money to that partnership. And so while it's nowhere near enough, based on what the Just Transition Investment Plan has asked for, that is a positive indication of support for those things. And our commercial banks, pension funds, increasingly financing renewable energy and transition-related projects. And we're also seeing from a smaller scale, though, that there's a growth in the types of initiatives that are channeling funding, for example, into clean tech and into climate-friendly SMMEs and innovations. So yes, there's political backlash in some areas, but these, I think, are really positive signals once you look beneath that.
Great. Thank you for sharing these encouraging developments. And Simon, how do you see it? Are we experiencing a backlash, and where do you still see steps in the right direction?
Yeah, no, thank you. Happy to speak about this. I guess also maybe as a starting point, a little bit in the context of what we are doing at LSE. So for example, I created this new Center for Economic Transition Expertise, which is a center that focuses exclusively on supporting central banks, ministries of finance, supervisors, when it comes to integrating climate or transition considerations into their core monetary, prudential, fiscal policy frameworks. We thought a lot about how to frame this and how to translate our general research in the sustainability space into policy arguments that are also politically acceptable. So, I mean, very trivial, but you can see the name, Center for Economic Transition Expertise, doesn't include sustainability or climate or nature or environment or anything like this, even though it is exclusively focused on sustainability. So I think Shamila said this very nicely, and I could not agree more. It's all about making the economics work. And if the price is right and the economics make sense, then you can make a very powerful argument for the transition. And that hasn't always been the case. And I think also framings like the ESG framing. So you group through three very different and very complex things together into one framing: the environment, the social dimension, as well as the governance dimension. You bring this all together, you say this is the same, and now you need to somehow disclose, address, take into account or whatever. And that is definitely something we very consciously tried not to do. And I'm happy to later on go a little bit into the details on the different policies, but we spend an enormous amount of time thinking about this framing. And I think we especially have a backlash where the case hasn't been made in the right way for transition measures, adaptation measures, whatever the dimension is. But you can't just make a social or just a political argument. You also need to bring the economic argument in. And you can't just make an economic price argument without considering the political dimension. And maybe also responsibility for researchers to think about how to frame an argument, how to indicate the trade-offs and the cost discussion, recognizing also, I guess, the time horizon problems, that maybe it is cheaper to now transition rather than to bear the costs of climate change later. And it's of course the argument that our chair Nick Stern has made in the Stern review in 2008, 2009. But I mean, is this helpful to a day-to-day political argument and developments? Probably not. So this is something we are thinking a lot about. How do you find the right argument along political, social, as well as economic dimensions, and then yeah. Oh, someone is unmuted. And then maybe just to add one more dimension there, in the emerging market context, of course, you bring the sustainable and economic development dimension into all of this. And Nick, again, our chair, argued in his latest Green Growth book that the only area where we will find growth in the future is in the sustainability transition, given the costs of inaction and given the damages that we would expect without a transition, but also highlighting the enormous opportunities in this transition. And maybe an interesting example is Indonesia. So we've been working a lot on Indonesia, and one specific example would be nickel in Indonesia. So Indonesia produces, I think, or is mining half of the world's nickel, something like this. And the big question is, what do you do with this nickel? Do you just export this, or do you refine it? And then if you refine it, you have nickel, and then you can potentially also go into battery manufacturing. And once you produce batteries, you can potentially go into EV manufacturing. Of course, there are technological questions. Is nickel used? Will nickel still be used in the future, in future battery technologies? But you bring in all of these trade-offs. So from an Indonesian point of view, there was an argument for a very long time that this is the economic growth and economic development opportunity. But then nickel mining is energy intensive. It's highly polluting. It's therefore also very emission intensive. You have trade-offs between expanding mining for battery minerals and deforestation, land use change. You potentially affect key ecosystem services that you need to keep your industry productive. So these are complicated trade-offs, and you try to, of course, somehow find growth and social and economic development in all of this. And this is where we with the center and the research at LSE try to shift a little bit the narrative and the focus, that you don't make this so much about to some degree also very Western concept of ESG, where it's kind of all the same, at least in the term, to an approach where you very carefully try to find the economic arguments along with the political dimension, and recognizing that transitions have enormous social and job implications. So I think Shamila put this very nicely, a little bit from the other side, but I could not agree more. So I see the backlash, especially where we failed to outline why and how the economics make sense.
Thank you. Yeah, definitely important to keep also the social dimension and the economic dimension in mind when discussing this environmental issues. From my perception, I think we really see a heterogeneous development globally, in different jurisdictions, but also in different sides of decision making, in a sense, different aspects of the transformation. And I also think that even where we see a backlash, we should still look for pockets, for institutions where progress is still possible, and sometimes it might rather be more on a technical level, if the overall political discourse moves in a different direction. I know that there are still people in central banks and regulatory authorities that are interested in greening the portfolio of the central bank, or in better integrating sustainability, risk and financial supervision, to name just two examples. And it's worth supporting them and working with them to do that. So thanks to both of you for spreading some hope. The second part we want to discuss a bit more constructively, in what direction we should move beyond what we have heard about narratives and about making good arguments. What concrete policies are necessary to make the sustainable finance agenda more effective. And I think, from my perspective, making the sustainable finance agenda more effective has a lot to do with moving beyond the focus on creating transparency. Transparency is crucial because it's a prerequisite for channeling capital flows in the sustainable activities. But we need more. We need to change incentives. And we decided to go through a few policies. It's just a selection. I mean, there are many more on how that could be done on financial markets. Large part of changes of the incentives will come also from the real economy, from carbon pricing, from technological innovations in the real economy. But we would like to discuss what can be done on financial markets also to change incentives and investors to move beyond the current focus on transparency, on disclosure regulation and taxonomies and so on. And the first policy tools we would like to discuss are credit guidance policies. Simon, you have done a lot of research on credit guidance. So my first question would be, can you explain a bit what that actually is? And then talk a bit about experience that had been made in the past with these policy instruments. And you can refer to country cases. I know you have worked on the Chinese so-called window guidance, for instance. So I'd like to start with that.
Yeah, happy to. Yeah, I mean, I guess maybe stepping back for 1 second. I mean, I personally, I would very strongly agree with the idea that you need to go beyond transparency and think about like very substantial economic industrial policy to facilitate this transition. However, I recognize that what you want to do as a country depends very much on your political and economic system. You might very well live in a country where the government approach to policy is to let the markets solve problems. You have small interventions, but essentially you don't really want to intervene, and you believe in the invisible hand. And then on the other side of and the other extreme is, of course, that you have massive planned economies. You use markets where useful, but you definitely set priorities. You pick winners as a government, and you intervene, and you prioritize a green transition or certain kind of transition, and you make it happen through incentives or by even forcing companies and sectors to invest and operate in a certain way. So I mean, two extremes, but I recognize that it depends very much on what you want to do. And maybe some countries want a transition that is very unfair and very unjust, where you just have a few billionaires or trillionaires and you don't intervene and banks do what they want. And that is certainly an approach that some countries may want to choose. However, and this is the research that we've been focusing on a lot, is then the question of yeah, what are you mandated to do within the mandate of a given financial policy institution? And so we started with a lot of focus on central banks because and the argument was very easy in the beginning. The argument was climate change would affect the core objectives of central banks: price stability and financial stability. And we in the beginning, we were definitely very cautious to go beyond this. I mean, I would say this is relatively uncontroversial as long as you have the evidence that climate risks are material risks and they can affect the financial stability of institutions or the system. And then on the price stability side, the argument would be that droughts, for example, less water on the Rhine, would affect the overall price level of the economy. And for both, there's evidence, and I think this is to some degree the transparency side, but also something that is very much within the mandates. Where it of course gets interesting is where you go beyond this, and it's not something I would advocate for, but I recognize that a lot of central banks and supervisors do go beyond the pure price and financial stability approach. A lot of central banks are mandated to support, quote unquote, the economic priorities of the government. Case for the Bank of England, case for the European Central Bank, most certainly the case for a lot of emerging market central banks. And then it, of course, gets interesting, especially if you have instruments that support certain sectors anyway, whether that's mortgages, because you support home ownership, or whether that's certain sectors or whatever it is. Because then the question is, okay, if your government is committed to transitioning, you have instruments anyway that support economic priorities of the government, then why don't you add a green component? And I think this is where we see a lot of central banks add green components. People's Bank of China would be a good example there. People's Bank emerged, of course, from the Central Credit Plan in the 1990s. So very different systems, state-owned enterprises, state-owned banks, PBOC overseeing state-owned banks, regulating them, channeling credit into priority sectors, setting incentives, but also going beyond just setting incentives, maybe asking, maybe forcing. And then you can, of course, add green if you are committed as a government to adding green and transitioning. So I would hence be careful, recognizing that this is not for everyone. But if you do it anyway, you might as well do it in a green way.
Thank you. Just to add, I mean, even within the monetary mandate, I think now an additional reason to do something about fossil fuels might be that we see now the geopolitical risks that are associated with imported fossil fuels, no, and potential inflationary pressures that arise from that. I would also like to add a bit of research results we had in a study we did on sustainable finance taxonomies in South Africa, European Union, and Bangladesh, because Bangladesh is also an interesting case with respect to credit guidance policies. No, they have for quite some time now targets for the share of green loans of bank in place, also green refinancing schemes, so banks can get refinancing at the central bank at favorable conditions for green activities. And I mean, there are certainly challenges associated, limitations, no, related to vague definitions, greenwashing risk, and so on. But it was striking that almost all interviewees we talked to confirmed that these green credit guidance policies really made a difference. No? They really increased the availability of debt financing for green activities. So that's something that potentially useful. Right? As Simon said, probably not for everyone, but one policy that could be considered to change incentives in financial markets. I mean, we have only 1 hour, and so we would like to go quite fast through a number of policies. So let's move forward to development banking. That's a bit of a different type of policy, obviously, but they seem to see a bit of a revival at the moment, and I think could in principle also contribute to challenging capital flows to sustainable projects. Shamila, I would like to ask you on your opinion regarding the role of public development banks for green finance. What potential, what limitations do you see in this respect?
Thank you, Søren. So I have to state that I am not a banker. So this is from a non-banking perspective. But I just want to touch on a point previously that came up around the role of the markets. And, you had sketched out some different ways in which markets can be used. And Simon, thank you. I think those were just so helpful as well. I think that we mustn't, there's a risk in placing too much of, I think too much of, confidence into markets themselves alone without any sort of support. Because one of the issues that we can have is that market failure. And I think to some extent we can actually argue that there has been an extent of market failure. And that is that the market failing to allocate resources efficiently. And we know that that results in suboptimal outcomes for society and the environment. And so a point to hold is that markets never were premised off protecting environmental and social outcomes. And so when we know that that is an underpinning of some of the challenges with market mechanisms, we then, I think, understand that the role of these other actors are that much more important. And so, expecting that the markets will solve it just by putting the right things in is a challenging assumption. And we know that comes from issues like understanding that, they're premised off, and businesses largely are premised off internalizing profit and externalizing cost to society and the environment, And yes, we have had mechanisms to try to correct that. But I think that sort of fundamental understanding is critical in anything that we approach, and how much stock we put into market mechanisms alone. But anyway, so back to the question, I think around the role of public development banks. So I think in our context, certainly in Africa and South Africa, they perhaps the most important institution in that transition. And we can name a few if we look at that context. We've got the Development Bank of South Africa, the Industrial Development Corporation, the African Development Bank, the International Finance Corporation, and then, of course, what we refer to as the BRICS Bank as well. So it's a critical role because they can absorb the risks that commercial financiers cannot. And so their role in being catalytic is critical. And the clarity around their mandates then becomes critical, and the way in which they operate. So the South African climate finance data, I think, shows that concessional finance remains relatively small share of overall climate finance flows, but it's often really critical in unlocking the larger volumes of the private investment. And I think the numbers globally are telling us that public finance alone is never going to be enough to support the transition we have. And so the need for really robust mechanisms that can crowd in private sector finance and create that enabling condition is critical. And at the base of that, I think largely is the role that these development finance institutions play. And so they need to move beyond project finance and increasingly, I think, focus on, in our context, certainly your project preparation, blended finance, and your first loss capital tranches. Nothing here, is new to any of us, but it's really understanding how those can be arranged optimally and I think scaled. And then, of course, the provision of guarantees. And then aggregation platforms for smaller projects, because that is where that can become catalytic. So when we look at that and we want to ensure that we're tracking the amount that it's allowed, that it can actually start to catalyze from the private space. Aligned to that, I think, is that there needs to be an understanding that the conversations shouldn't be held in isolation. So when we know what needs to happen and we've got a vision, and I'm going to use South Africa's industrial development strategy for argument's sake, let's consider that that is the vision of what it is that we would like to achieve. Then there has to be a double click on, okay, so what then should a pipeline look like to be able to feed that? And then what are the barriers to investment? That shouldn't be a conversation that sits with the government or the development banks alone. You have to bring the private sector in early on so that you're able to make the best use of scarce resources. If the private sector is saying we can come in, but we can only come in here for various constraints that we might have, then what is the most optimal way to unlock the capital stack below that? Development finance, and could, for example, be even, philanthropic funding, for example, that helps to form the base of the capital stack in areas that traditional commercial or other finance won't be able to come in at. But that is difficult to create if you haven't had a co-creation process from the beginning. So I want to argue that the development of the pipeline needs to bring in the different actors earlier on into the agenda. It needs to consider the risk profiles of the various actors and where those are optimally then matched. And so the most efficient use of the scarce kind of forms of capital, which is some of the finance ones, some of the philanthropic sort of level, those kinds of areas that are no return profile, where they need to stack. Because without that look through from the beginning to the end, it's very difficult. And we continue to hear the issues like there's money, but there's no pipeline. The pipeline saying I'm here, but there's no money to match me. Somewhere in between, someone's not having a conversation. And I think that for me is really the important part of saying, I think that those development finance institutions can actually play a catalytic role in bringing together that bigger conversation aligned around a unified idea of what that vision needs to be. And therefore, I need this investment to unlock there because that's where I need to be in 10 years' time. And these are the players and actors that are lined up initially. My experience from the financial sector has been that it is often brought in too late into the process, and it has barriers. I mean, there's mandates, there's regulatory restrictions to the different forms of capital. And so at that stage, it's harder for them to mobilize. But if they're part of the process earlier on, as united actors in that space, there's a far greater chance that you can get the right money in at the right time, and it can move more quickly and it will go more efficiently to where it's needed in the real economy.
Okay, thank you for speaking so concretely about the process, no, and where development banks need to get in and can play a good role. I must say that I consider development banks also from another perspective as important. I mean, we have so much talk right now about that focus on private capital, no? And the argument is always public money is so scarce, ODA is decreasing, and so on. I think we shouldn't underestimate the significance of public investments. It's really a crucial part of the transition. Crucial parts will not be financed by private actors alone, no? And instead of giving in on the public budget constraints and turn to private capital alone, we should continue to fight for an adequate funding for public budgets to play this role, no? And as you said, development banks then also have a catalytic role, and they also mobilize private capital, for instance, also by refinancing themselves on the capital markets. No, that's also a form of private capital mobilization, obviously. Let me briefly mention that we also have a research project at IDOS on the National Development Banks of Ghana and Nigeria, led by my colleagues Chris Sommer and Yabi Balvalle. So if you're interested on this topic, look out for the upcoming results and publications. We can only give you a snapshots now of all these different topics we discussed, okay? Next, I would like to turn to transition plans. That's also a tool that's has led a lot of discussions in last years. Simon, in a paper, you and your co-authors describe different types of transition plans that exist today. Maybe not all of them classify as moving beyond transparency, but some clearly do. So can you elaborate a bit on the different types of transition plans and their role and how they can be used, for instance, by financial supervisors?
Yeah, definitely. I guess transition plans are also, again, a very interesting framing in the context of where you want to put them? Do you want to think of them as something voluntary, market-led, transparency connected, kind of little bit in that space? Or do you want to frame them through a little bit more mandatory, mandate-aligned angle? And this is what we try to do in a paper, in a recent paper, namely through the prudential angle. So we argued that transition plans could be an interesting way, prudential transition plans could be an interesting way for financial institutions to outline how they are planning to transition. This could be based on certain expectations by financial supervisors, and then supervisors could assess the quality and the ambition and I guess the degree of realism of the transition plan. And if there are concerns, there could be a penalizing factor. There could be a prudential reaction to insufficient transition plans purely based on a risk argument. So we've been framing this again in a very careful European context, where we recognize that EBA and supervisors are first and foremost concerned with financial risk. So the question was, could you make an argument for transition plans that would, of course, hopefully also advance the transition and align financial flows with the transition? Could you make an argument and make them powerful from a prudential point of view? So it's a little bit what I spoke about earlier, that we try with these policies to fit them into a specific political and economic context. So I think transition plans are, I mean, it was a trend, or it is a trend, to talk a lot about transition plans, and this would be a way to make them prudentially relevant and use them as a financial risk assessment tool, and then to also penalize based on a prudential argument. I guess more broadly, yeah, that is something you can do as a supervisor, absolutely. But I guess it should sit in a broader space of interesting policies. And this is the prudential angle. Then there is, of course, the monetary angle, credit guidance that we spoke about, in terms of how do you use instruments, how do you frame your collateral framework. You want to make sure that you don't have a bias. But I mean, if I'm honest, the work of CTAX with 45 staff by now is very much moving towards fiscal policy. So we have the feeling that we've outlined a lot of the technical details on how to adjust prudential and monetary policy, and a lot of it seems to be now up to political will and commitment, and often also, I think, Sören, you mentioned this, the commitment of individuals. Do you have a committed central bank governor or not? Is there someone on the board who's supporting interesting stuff? Maybe not. And on the fiscal side, we are trying with, for example, fossil fuel subsidy reform. We feel like there is a lot more space to make also this National Development Bank investment argument, that you invest, you have opportunities, you create growth, you make sure that the subsidies are somehow aligned with this. Of course, there is a role of prudential policy, of transition plans, of monetary policy to create the right environment. But I think generally, I'm observing a little bit of a switch and a move towards these big economic policies where it's also about making the right economic and then political argument. Transition plans in this broader policy space are more something that we try to push through a prudential narrative, because then it should be politically not sensitive. Because it would then be the argument, well, it's within the mandate, it's a tool to assess and to potentially mitigate. But that is, of course, also I'm by training a monetary economist. So I, of course, very well remember the Greenspan doctrine before the 2008 financial crisis, where the approach was, well, we don't intervene and we clean up later if there's a bubble. And I guess of course, with the financial crisis and macro-prudential policy and leaning against the wind, the approach has changed there. And I guess this is the context where we try to then also pitch transition plans as a way to lean against the wind, to get financial institutions to think about the transition, to disclose, and then to potentially intervene if there is misalignment or if there's a problem. So it's a very careful instrument compared to what else you can do in this broader space with like MDBs or national development banks and fiscal policy, in terms of really finding innovation-focused investment strategy around opportunities. So very different ends of the spectrum, just to give it a little bit of context.
Thanks. Yeah, I mean, I must say I find it a bit unfortunate that as part of the omnibus legislation, the EU has removed the requirement to adopt a transition plan from the CSDDD, the due diligence directive. I mean, still part to disclose a transition plan if you have one under the Corporate Sustainability Reporting Directive, but that's weaker than before. And on the other hand, I mean, transition plans are part of the IFRS sustainability disclosure standard. So this might be a reason to see a bit more of global distribution in this respect. Shamila, would you like to come in also on this point, or shall we move on?
So not much more to add, but I think just because our perspective is quite closely working with the real economy, and I think transition plans are hugely useful in that regard. And you mentioned the disclosure perspective just now. So I think disclosure sort of tells us by and large where a company is today. And yes, some of the disclosure requirements require to look at risks and look at opportunities and disclose some of those as well. But the transition plan really is focusing on telling you where it intends to go and hopefully how it intends to get there. And I think the practicality around that is hugely important because it helps investors and it helps, the stakeholders that need to understand what that means. And then directly also impacts on the investability or the investment attractiveness of that company because you would very much prefer to say, so I'm looking at obviously from a company disclosure perspective, I would very much prefer to know that a company understands where it's at and where it needs to go and is clear about the transition period in that is not going to go from brown to green overnight. And there's a pathway that's created. And so it develops an element of trust. Of course, it needs to perform and, disclose alongside that and be able to prove evidence over a period of time that it is actually doing what it said it set out to do. But what it does then do is make clear some of those decarbonization pathways that it wants to undertake, the workforce transition strategies. And I think in a country like South Africa, that is particularly relevant and very practical for us because, you're at risk of destabilizing the entire agenda on transition if we're not answering to the workforce issues that we have. And so those very practical things could be contained in those transition plans and the disclosure thereof. And then, of course, the resilience measures and the capital expenditure plans that accompany that effort. And so that's quite a practical kind of real economy where disclosure meets practicality and the confidence and trust that is required both from stakeholders at large in what is also a social transition in relation to the transition in the economy and decarbonization, but then also the economic transition as well as the underpinnings of what that means in investors having confidence to support what might not be immediately green, but is in a process to get there.
Thank you. Yeah, I think there are also good economic arguments for the individual economic actor to be made, no, for a transition plan, for actually planning for the transition, as Simon said at the beginning, no, that's a good argument that can always be made. The last policy lever I would like to focus on is tax policy. I mean, Simon already mentioned fiscal policies. I rather mean tax policy here as a more narrow instrument to redirect capital flows on the financial markets. I think there are some experiments in this respect, for instance, in the Netherlands, but not many countries use tax policy in this respect. One way to do so would be to differentiate capital gains taxes according to the environmental credentials of financial products, requiring those investing in dirty activities to pay higher taxes, internalizing at least part of the external effects of these projects. I think the argument is pretty straightforward and easy to communicate. No, profits gained from environmental harmful activities should be decreased, should pay more taxes. I'm not a tax expert, can't speak about potential implementation challenges, but this is something I would like to see being explored more. No? And there are certainly much more options with respect to tax policies. I mean, there have been proposals of green financial transaction tax with lower tax rates for transactions of green assets. There are certainly a few options. Would you like to comment on that as well, Shamila or Simon?
Happy to make some high-level comments on that, I think, Suren. So we know that tax policy does remain to be one of the strongest levers available to governments. And we need to look at, and South Africa has a carbon tax that is implemented, and it has formed an important foundation. But the other side of it is that are there strong incentives? And I think it goes back to the visioning of what one wants to achieve in that economy. And so you can't go all out on the tax, but not have the enabling environment created for the other side that needs to develop. Because part of the challenges that I think that governments have is that, and there's different types of taxes. So there's obviously just the carbon tax, which is one instrument. But then you've also got to look at the taxes that sit and the levies that sit, for example, in fossil fuels. There are a number of those that are applied in there. And one has to acknowledge that it's a challenge for certain governments to really think about how you're going to replace the income that you're getting from those levies that are sitting in the system. So when we think about taxes, I think we need to look through the entire system and where they sit and where those incentives might sit. And I think, as Simon framed so beautifully earlier on, is what is the political, social, and economically acceptable way to do that? And how do you make that attractive from a government, for example, because I'm talking about the levies that they're getting on the one side, which effectively, are working at counter purposes in some instances to carbon tax on the other side. And so how do you work with those two to make sure that a government can see its way through reducing potentially levies on one side and being able to support and rechannel into incentives for growing the right things on this side? And yes, there's the carbon tax. And so the suite of measures in service of a bigger vision, I think, is what we need to look at. And it's when we do these things piecemeal is that when we really start to see the challenges, the pushback that you're getting from industry in certain instances, and because it just lacks that coherent vision. I don't want to give up on this because where do I go after that? And so this clarity of thought process through that, but then the clear understanding of the systems that are going to support that is going to be important. I mean, some of the other examples is accelerated depreciation for clean technologies. Those are really good incentives that one can look at. Tax deductions or incentives for electric vehicle manufacturing. I mean, in South Africa, there was 150% tax deduction recently for investments in electric and hydrogen vehicle manufacturing in South Africa. And so that's a good example of where the kind of fiscal policy support can be both for industrial development, but also for climate objectives. But then again, it's looking at both sides of the coin. We're also looking at incentives for battery storage and infrastructure, and of course, the tax incentives for green industrialization and local beneficiation. The point that Simon made as well earlier on, looking at nickel. South Africa is a country that's sitting with a number of the critical minerals, and it's a similar challenge that question that you're going to have is that how do you make sure that you're making the best use of that, but that it is along sustainable lines and that you're able to do that? But I think the use of those minerals also to power a more sustainable economy. So it's really quite a multifaceted thing that looks at both the tax side as well as the incentive side. And again, the clarity on the vision of what it is that you want to achieve.
Good. Thanks for widening the picture again a bit, no, and looking also on the tax policies in the real economy. Unless you have something very urgent, Simon, I would go on.
I could not agree more. I mean, I think Shamila put this perfectly. I would have had almost the same answer, but in less articulate words and framing. I think very powerful to recognize that it's usually easier to support rather than to penalize. So you support opportunities. You have an opportunity framing rather and you subsidize something rather than you penalize something with higher taxes, also just politically. And of course, the social dimension is absolutely essential to consider here. I mean, fossil fuel subsidies. If you think about the insane amount of budget that is spent on fossil fuel subsidies, which are politically, of course, very sensitive to touch because they support the general population. Cheap fuel especially benefits those who have lower income. So that is something that I guess from an academic point of view, kind of low-hanging fruit, you would think, something you should reform right away. But that is sensitive, and finding there the right social angle, also the right political angle to create an opportunity with subsidies for something rather than taking something away from part of population, that is tricky. So I fully agree here.
Good, thanks. Yeah, I mean, we have discussed a few potentials, no, potential possibilities. I think there are many more, but I would like to go to the questions from the audience. I think we have two questions from the audience by now. We don't have much time left, but we can, we think, very briefly address them maybe. The first one, with respect to transparency, my question is, green or amber finance is usually linked to extensive MRV, so I think monitoring, reporting, verification. In your perspective, should all investment and finance need to require MRV to support a shift towards amber and green finance? And then we have a second question. When you discuss transition plans, are you referring to countries, industrial enterprises, or financial institutions? Where precisely do you see the link to potential considerations? Yeah, I guess, Simon, you can take the one on transition plans, maybe.
Yeah, I
Which
already posted a quick link in the chat here. Sorry, I should have been more precise there. Banks and financial institutions, hence prudential and hence financial supervision. However, I mean, it doesn't have to stop there. There was recently a paper that we supported on sovereign transition plans, and I guess also the question of how do you develop a transition plan, let's say as a bank, if you don't fully understand what your government's transition plan is like. When should you as a bank expect certain sectors to be deprioritized, to disappear, to be phased out? And what does this mean for your portfolio and the alignment or misalignment of your portfolio? And as a bank, you of course need to build on something. You need to build on the transition plans of your clients, on the transition plans of corporations, maybe even SMEs or MSMEs. Can MSMEs produce gold standard transition plans? Different question. So I recognize that it's part of a broader concept. You need clear signals from the government. You need bottom-up transition plans and transition planning. I guess what we try to do here as a thought experiment is to say, or to outline how it could be framed from a prudential financial supervision point of view, just to clarify.
Thank you. Shamila, do you have an opinion on this transparency question?
Support completely what Simon said. I think that's clear. Thank you.
I know I meant with respect to the other question on whether you think that all investment in finance need to require monitoring, reporting, and verification to support a shift towards amber and green finance, to balance these requirements that the green finance, they have more reporting requirements than the others as a disadvantage.
I think that's an interesting question. And my instinct is to say yes, that you want to get, but I think the question is going to be on what additional do we want from the other financing, and some of the discussion earlier on. And I get somewhat the whole question on disclosure has been trying to answer that, right? It's taking the mainstream, it's asking it to disclose its risks and its opportunities, and ideally that should find itself into those frameworks. But the additional step in the MRV after that, and if you look at it for green bonds generally, they're requiring you to put that reporting out annually, right? On whichever that is, green bonds, use of proceeds, or whatever structure there is. And I think maybe that's the next step, is to look at saying, okay, you're doing that disclosure. Is there a specific thing, if, for example, it's in a bond portfolio, whatever, that then happens annually related to that bond specifically? So I think we can take some of the lead from the broader disclosure narrative that's happening, whether it's IWSB or the others, and see if there's a specific way that it needs to find its way into the sorts of framework that I referred to here.
Right, thank you. Yeah, unfortunately, we are already over time. But if you are interested to read more of our thoughts on this, we have a policy brief with the same title than the webinar on our website. I think my colleague already provided the link in the chat. And we will also make the recording available, so feel free to refer to others if that's interesting for them that might not be able to attend. With that, I would like to thank our two guests, Shamila, Simon. Thank you so much for joining us today, describing your insightful perspective on these issues. Thank you. And certainly also a great thing to everyone participating. Yeah, and enjoyed this conversation. I hope it was useful for many of you. So please join us again for the upcoming webinars in the coming months. We will have a few in autumn and then in the next year. And yeah, thank you and have a nice rest of the day.
Thank
Bye.
you so much.
Thank you, and thanks for everyone who joined
Bye.
us.